Have you been wanting to own real estate and create passive income from excellent leaseholders? Well, today's your day. Today, we're talking to Millennium III, who has had a fantastic track record of developing and delivering excellence for clients. Take a look. Hey, welcome back to Money Match. It's Ian Ardill here. We are joined together today with John Kearley. John is the president of Millennium III, an excellent asset manager, and we're going to learn a little bit more about what they're doing for clients today. John, welcome to the show.
Thanks, Ian. Thanks for taking your time to learn about our products.
John, I'm wondering if you can tell us a little bit more about Millennium III, and just tell us, who are you guys and what are you about?
Sure. Well, we began investing in Western Canada over 42 years ago in 1981. We are a second-generation company, and we've managed to amass a portfolio of about $500 million of assets under management over that time. And we have an investor base of approximately 1,600 investors across Canada. And we've had the opportunity to provide them with a good opportunity to invest in commercial real estate from a collective perspective.
John, so tell me, ever so much, if you're just kind of riding the elevator with somebody who wanted to know more about Millennium III, give me the elevator pitch.
Yeah, the elevator pitch is pretty simple, Ian. It's an opportunity for people to participate in commercial real estate without having the attendant risks associated with it, but also to experience a good opportunity to provide long-term income as well as tax-efficient investing.
So tell me about that, because I want to just quantify this for a moment. A lot of our clients have exposure to REITs, which stands for a real estate investment trust. And so they deploy and they're participating on a macro scale across a portfolio of investments. You have a little bit of a different structure that has, some added tax incentives. Can you tell me a little bit about the actual structure? How are people investing with you?
Well, it's a limited partnership structure, which is a little bit different than a REIT where you're available to people in the public markets. But this is more like a private REIT, essentially, where people have the opportunity to participate in the ownership and the income available to them, as well as the tax write-offs available to them in the property that we purchase. And but they're not obviously in the public market space. So it's a good opportunity to have a more private look at commercial real estate ownership.
So give me a snapshot. In essence, you have a very unique structure that they buy a share and then they get a whole bunch of write-offs associated with that share. And then there's this kind of interesting waiting period over the next 14 years before, things start to materialize from a cash flow standpoint. I'm wondering, obviously I'm making generalizations and every limited partnership structure is unique to that property, but I'm wondering if you can just walk me through the numbers and the general kind of, average experience of what a client might experience.
Well, pretty simple, Ian. Basically, your initial investment is $24,700. And with that investment, you purchase one unit in the limited partnership. Now, based on the write-offs associated with, that we have available to us through the write-offs of soft costs and hard costs of redeveloping the property, usually in the first year, you're going to write off almost about $12,500, give or take. And so, that's an aggregate of money that we spend on the property to reposition the property in the marketplace. We also look for assets that are a little bit less taken, I guess not taken care of, but that need a little TLC. And that's part of our program, is to reinvest in projects and build the rent rolls accordingly.
You're highlighting something that's really neat. There's a project that you're involved with right now, and I don't want to necessarily get into the details into a singular project, but I found it fascinating that live right now, investors are jumping into a project that currently have a rental rate from a lease perspective around $5 a square foot. Is that correct?
Yeah, that's correct. Yeah, yeah. It's a very good buy. It's an industrial property located in Regina, Saskatchewan, obviously. And we, what we do is we look very, very hard for good opportunities in income appreciation as time goes by.
And so, okay, so we're in Regina. What is the vacancy rate in Regina right now? Do you know in industrial?
Currently in industrial, the vacancy rate is about 1.75%. So it's very low.
So what you're telling me is there is no vacancy.
Well, essentially, and in our marketplace, we look at about 10% as a good average across the board throughout the long term, and we're a very long-term play. So when I find something like this, an opportunity with a very low vacancy rate in a marketplace, I look very, very, hard at that opportunity.
Okay, so in Regina, do you know off the top of your head what is the average square foot price for an industrial space?
Well, to build nowadays, it's quite interesting. It's about $250 a square foot to $300 a square foot, depending upon, your level of fit and finish, essentially for industrial. So it's highly costly. Inflationary factors are at play. Materials, labor are quite expensive, and also it's challenging to just get financing at some points. So we look for these opportunities that are a little bit, older and have some upside available to them.
Yeah, and I guess where I'm highlighting on this particular project, and I think it's indicative of how you guys look for projects, is right now the market rent in Regina for industrial is around $11 a square foot. And you're picking this property up that's currently leasing out at $5 a square foot. So with a little bit of TLC that you've described, it's reasonable that as these leases roll over, that you'll be able to close that margin, creating substantive value for your proportionate shareholders of that property. Is that a fair statement?
That's exactly what we look for. And, a couple things, the property is fully leased out. It's 27,500 square feet. And there's about 7,500 square feet that's at $5 a square foot. So, the other side of the property is leased out at about $8, $9. So there's some upside available there too. But the real upside is obviously available in that 7,500. So we always look for opportunities like that. Ian, that's the bread and butter of our business. And having those available to us is built on a network of contacts that we have in different marketplaces where we see a lot of things before they even hit the marketplace, which is an advantage that we've built over the years.
So John, tell me this. So if I'm an investor, I like you guys. I think you're kind of a reasonable manager of assets, and certainly you've had a fantastic track record in terms of investment deployment. Walk me through the life cycle of somebody's deployment on a singular unit. So if they decide, yeah, I really want to partner with Millennium III on a project. What does that look like?
Well, I mean, obviously it starts in with the initial investment of 24,700. And in the first year, you're going to write off approximately 12,500, depending on the project. What happens is as and we put some debt on the property in the first part. Essentially, a mortgage will get placed at the same time, and capital raised at the initial stage will start to pay down our mortgage. So that we have a shorter amortization of about 14, 15 years, depending on project. And what happens is the income from the property slowly pays down the mortgage. We do smaller distributions. Any excess capital available to partners are distributed on a yearly basis. But we really apply most of our opportunity to reduce debt in the most quick way as we possibly can. And so over that 14-year period, you'll see some significant debt reduction to a point where we get to a mortgage that is retired, depending obviously on, cycles and, economic factors that may be at play. But our goal is to do that after that 14 to 15-year mark, and then it becomes an income vehicle. And so it starts to produce as time goes by. Once we build a little bit of a reserve, it'll start to produce, a little bit more. Distributions increase up to a point where we're targeting approximately, $5,000 on a yearly basis, and not obviously in pocket, but that's 5,000 net rental revenues. So essentially, it becomes a long-term investment vehicle or long-term income vehicle, but with a nice tax front end.
Yeah. So, John, maybe just talk to me a little bit about the macro strategy. Somebody could obviously invest in a singular project, but I think the real value for Millennium and somebody's retirement portfolio is really talking about perhaps a laddered approach. I'm wondering if you can speak to that.
Well, I mean, one of the advantages to our products, Ian, is that we do have each individual project is its own solo partnership. So it gives people an opportunity on a yearly basis to diversify their holdings in commercial real estate. We'll have one that might be an industrial, one that might be a retail, uh, one that might be in one marketplace, say Edmonton or Regina or Saskatoon. And you get a little bit of diversification through that, but you also sort of still have the similar structure that goes throughout the entirety of the cycle. So it allows people to, spread their risk out in different marketplaces as well as, different sectors of the marketplace. And we found that to be quite successful.
So, I'm wondering if I can just be so bold and walk this through. If somebody was in their 40s and 50s, making reasonable amount of income in their, what I'd call your higher income earning years, somebody could be making annual deployments to Millennium III and getting the tax benefits early on in those years of deployment. But, by the time they're, in their 60s, they now have almost like an annuity generating a growing return every year. Now, obviously, I'm making generalizations and not specific to any one fund because nothing obviously is guaranteed. But generally speaking, one could anticipate the lease yields slowly going up with inflation. And one could anticipate that, hey, if you started deployment back here and did annual deployments, more and more of those assets later on are going to slowly become coming online. And so you almost have this laddered annuity kind of assets that are coming online from an income standpoint. Would that not be a fair description?
Well, that's exactly the model, Ian. And, we really find that our main investor base is in and around the 50s mark, but most of them that we talked to over many, many years wish that they had started earlier. And simply for the fact that, when you're in your high earning years, it's a great opportunity to save yourself some taxes, but also to put some money away for the future. And, from an annuity perspective, that's essentially, kind of how we position it in people's portfolios. It's important to sort of recognize that this is money that you're going to set and forget, and money that is slowly going to pay down its debt and be available to you in your later years when your income, when your earning capacity may be different. So that's exactly how we position it.
And I don't want to be like, I don't know, John, if you're insurance licensed, but I am, and I certainly can speak to this, that annuities, I'm not necessarily anti-annuities. This is not meant to be a knock, but when somebody buys an annuity, yes, it's guaranteed yield, but in a traditional annuity structure, once you pass away, it's gone, and oftentimes rolls over to the spouse in a kind of at a reduced capacity. So, John, just so I'm clear, like if comparing this apples to apples to an annuity, if you have two spouses and this spouse passes away, what happens to this Millennium III revenue stream?
Well, the revenue stream stays the same, and I mean that's the benefit of our offerings, in that revenue continues and increases as time goes by, as rents increase and the value of the property increases accordingly.
Is this an asset that even, and again, there's tax implications whenever something rolls over to the next generation, but just to be clear, does this disappear with like the two spouses, or can this actually get willed on to the next generation?
Well, there's a perfect time, Ian, to actually transfer it over to a child or designate of that's above the age of majority. And when the fair market value and the adjusted cost base are very similar, they can transfer it at a very, very low cap gain, and have an opportunity to take the income, pass it on to a future generation, but also benefit from the initial write-offs available to them when they initially invest. So it's a fantastic tool for long-term income planning and long-term planning of your children's or whoever it may be, their financial future.
John, this is a fantastic and very unique tool that I think can be a powerful tool in somebody's portfolio. So, John, thank you so much for explaining this to us. I'm wondering if we can end with this question. Why Millennium? Why Millennium III? Why should somebody trust you with their capital?
Well, Ian, we've been doing this for over 42 years, and we've seen the ups and downs of the marketplaces across Western Canada. We've seen recessions, pandemics. We've seen a litany of things that have happened throughout, and we've gained an amazing amount of experience in the marketplaces through that time, and through dealing with our investors, some of which have been with us for 35 to 40 years. And we've watched their portfolios grow as time goes by. Every year, I have an opportunity to put out our distributions twice a year, and I watch those checks get bigger and bigger, and the stacks get bigger and bigger. And that's one of the best things that I see in our company, is that opportunity for people to participate over the long haul, and to have that opportunity to really rely on a manager that has experience in the marketplace, that takes a very conservative approach to our risk. And that was why I would say why Millennium. We've grown for a very, very long period of time from our experience. Thanks, Ian. I really appreciate the time and the opportunity to participate in this. And thanks for your time.
Thanks, John. So appreciate you being here, and join us next time on Money Match. If you have questions, our door is always open.